indicators. Let's start with some basic indicators that you can use when you start trading. Indicators are statistics that are used to measure current Forex market conditions and to project future market trends. Your job is to choose the best indicators and combine them in a way that will give you an advantage during trading. Ideally, you want your indicators to confirm the information you are getting from each one, rather than duplicate the information. There are 7 main chart indicators that are used extensively by Forex traders. One of the most popular indicators is Bollinger Bands. This is an indicator that was created by John Bollinger and is used to measure the volatility of a market. This tells you whether the market is loud or quiet. When the market is loud, the bands expand, and when it is quiet, they contract. There are several ways you can apply Bollinger Bands to make more effective trades. The Bollinger Bounce is when the price returns to the middle of the bands. The reason the bounce happens is because the bands act like dynamic support and resistance levels. The bands will be stronger the longer timescale you use. The Bollinger Squeeze is an indication that the price is getting ready for a breakout. The bands get closer together during price consolidation, and if the price starts to break out below the lower band, the price will start a downward trend. If the price starts to break out above the upper band, then the price will start an upward trend. MACD. Another useful and widely used indicator is the MACD. This indicator is used to pinpoint moving averages that hint at a new trend. You will see 3 numbers on a MACD chart that will help you determine the meaning of the indicator. The first number is the number of periods that is being used to calculate the faster moving average. The second number is the number of periods that is being used to calculate the slower moving average. The third number is the number of bars that is being used to calculate the average of the difference between the slower and faster moving averages. You can use these 2 moving lines with different speeds to predict a trend. For instance, when the difference between the 2 lines is 0, a crossover can occur, which can signal the start of a new trend. The only disadvantage of MACD is that the moving averages tend to be slower to react than the price, but it is still the tool of choice for many traders. Parabolic Stop and Reversal, SAR. This indicator signals the end of a trend rather than the beginning of one. This is helpful for traders so they know when to exit a trade. A parabolic SAR places dots on a chart that show traders where there are potential reversals in movement of the price. If the dots are below the candles on a candlestick chart, they are indicating a buy signal. If the dots are above the candles, they are indicating a sell signal. This indicator works best in markets that are trending either upward or downward. You should not use a parabolic SAR when the price is moving sideways. Stochastic. This is another indicator like parabolic SAR that can tell a trader when a trend could end. It measures oversold and overbought conditions in the market. It has 2 lines which are similar to the MACD lines in that one line moves more quickly than the other. The stochastic is measured on a scale of 0 to 100. If the lines are above 80, then the market is overbought. If the lines are below 20, the market is oversold. Typically, traders buy currencies during an oversold market and sell currencies during an overbought market. Relative Strength Index. Relative Strength Index is another indicator that helps traders identify currencies that are oversold or overbought. It operates on a scale of 0 to 100. Readings over 70 indicate that the market is overbought. Readings below 30 indicate that the market is oversold. This indicator can be used to verify trends. If you believe an upward trend is possible, the RSI should be above 50. If you believe a downward trend is possible, the RSI should be below 50. Average Directional Index. The ADX indicator has a range of 0 to 100. Readings that are below 20 indicate a weak trend. Readings above 50 indicate a strong trend. This is different from the stochastic because the ADX simply measures how strong the current trend is. This indicator is used to determine whether a market is starting a new trend or if it's ranging. It's not going to tell you whether you should buy or sell, but it does tell you whether or not it's safe for you to start trading in a continuing trend. Ichimoku Kinko Hyo. This indicator is made up of 5 lines that gauge future price momentum and future areas of resistance and support. It is mainly used for pairs that include Japanese currency. Kijun Sen, blue line. This is the baseline that averages the highest high and the lowest low over the previous 26 periods. Tenkan Sen, red line. This is the turning line that averages the highest high and the lowest low over the previous 9 periods. Chiku Span, green line. This is the lagging line, which is the current day's closing price that is plotted 26 periods behind. Senku Span, brown and beige lines. One Senku line averages the Tenkan Sen and the Kijun Sen plotted 26 periods ahead. The other Senku line averages the highest high and the lowest low over the previous 52 periods and is plotted 26 periods ahead. Essentially, the IKH rolls support and resistance, trend indicators, crossovers and oscillators all in one chart. Once you learn how to read it properly, it can give you a ton of information at once. Most traders use at least 3 different indicators to make their trades on Forex. Unless and until all 3 indicators are giving them the same signal, they won't make a trade. The indicators you ultimately use will depend on which ones work best for you, so you'll need to give them all a try until you find the right combination.